Hey everybody, it's your boy, Bryan Karp, aka Mailbox Money with my man, your man, the myth, the legend, Anthony Loffredo, aka the Professor, and this is by far our favorite podcast to do, and all of you guys have given us so much accolades for, wait for it, drum roll please, Behind the Bricks. And now our podcast is sponsored by Future Gen REI. Anthony, how you doing this morning?
I'm good. How are you?
I'm fantastic. On our last Behind the Bricks, what we spoke about was our newest acquisition or our newest property that we were fundraising for, which is the Troy Apartments. Anthony, why don't you bring everyone up to speed exactly where we are with our 36 unit value add Troy Apartments in Dyersburg, Tennessee?
Well, right now we're in the fundraising stage and we're in the process of getting our applications completed for the funding from Fannie and Freddie.
So the big thing that is different between this acquisition and our first acquisition is our first acquisition, we were purchasing our first 51 unit from a professional investor.
Yeah.
Right? Our newest acquisition is coming from a mom and pop. Talk about the differences and the parallels, and let's be totally candid with people. Our application is frozen with Freddie Mac because the seller couldn't get us the information we needed. So kind of unpack what that looks like so everyone understands.
Yeah. So when you're dealing with Fannie and Freddie, they rely a lot on what you provide them that the seller provides you. So you're like a middleman trying to get the information from the seller to provide it to Franny on Franny's timelines. So you're almost, your back's against the wall a lot of times if you don't have a seller that's in a position to provide you with everything when you need it, when you ask for it right away. A lot of times their stuff isn't organized, it's not up to date. So, it puts you in a tough position in order to kind of furnish everything that Franny and Freddie are asking for. So
when we first started this whole venture, I was like, oh, we got to buy deals from mom and pop. I was picturing people living in a trailer that owned an apartment complex. We got to be buying from mom and pops. But now that we've walked both ways and we bought from a professional investor who owned 2,500 units, and now we're buying from a mom and pop who has 36 units, it's almost you always feel like you can get a better deal from mom and pop.
Right, you can, but a lot of times the reason why that deal is good is because it's mismanaged. And the part that goes along with that is that they don't have good books and they don't keep good records, and so it's a catch-22.
Yeah, it's a real catch-22, and it's funny because this deal currently is not even financeable because the bookkeeping is such a travesty and so unorganized, and they don't have their act together. So it's funny, with this big multifamily space, they're not looking at Anthony and myself's financials. They're looking at the asset that you're purchasing.
Right. Yeah. So it makes it challenging. If you're not upfront with the seller right out of the gate, knowing what you're going to need that's going to be requested from them, you have to kind of put that into the contract and say, hey, listen, we're going to need extensions. We're going to need this amount of time if you can't furnish us with all this information on a timely basis.
And it's funny because when you're dealing with a government agency, it's not like you could say, well, I can't get this to you until next week. They literally give you the timelines. And if you don't abide by the timelines, they're just going to shut down your file. And they froze our file, which basically means they want to let it sit for 30 days. They want us to gather all the documentation that we're going to need for the next 60 days. And then they want to make sure that we have everything ready and roll where we could submit it to them and that they can move the file forward in their underwriting process.
Right. Yep.
Talk about some of the documentation that they asked for from the seller.
Well, they want a T12, so they always are going to want rent rolls. They're going to want the operating statements on a month-to-month basis. They're going to want copies of leases. They're going to want they're going to want previous surveys, COs, real estate bills, all of the support that goes along into all the financials. And then they want updates every couple weeks of all of that information as the applications go in. So it's not just asking for it once, it's asking for it and then asking for it 2 weeks later, and then 2 weeks later, and then 2 weeks later. So, and especially if they're not used to, being good at keeping books and doing all, and keeping their records and being organized, you're chasing them.
Yeah.
That's what happened.
For the listener who doesn't know what a T12 is or an operating statement, just tell me, because as of 2 years ago, I'd never heard the word T12. Tell me what a T12 is. Tell me what an operating statement is.
A T12 it's a trailing 12. So it's the previous 12 months of performance of the asset from an income and expense standpoint. So same thing with the operating statements are same thing. You want all of your income and all of your expenses, and then all of your debt and all of your, you want it all nice and organized and in monthly statements.
This amazing content is brought to you by Future Gen REI. Future Gen REI is a local syndication organization with Anthony Loffredo and Bryan Karp as the syndicators, with over 20 years of multifamily experience. We purchase B and C class assets in secondary and tertiary markets in Tennessee. If you're interested in investing, please reach out to us. We're super, super excited to help you build future wealth with Future Gen REI. Something else that I didn't know until we've walked now 3 properties with financials is they're also going to want to make sure that there's a certain amount of occupancy. Right. So the government agencies, Fannie and Freddie, they want to make sure there's a certain amount of occupancy in the building. They want to make sure that the rents are being collected properly. They want to make sure the trends are upward.
Right.
And it's funny because on the residential space, it's all about the borrower, the borrower, the borrower. In this multifamily space and syndication space, it has nothing to do with the syndicator at all. It's all about the asset.
Yeah. Yeah. Which, comes back to making it challenging. And a lot of times when the sellers, especially the mom and pop ones, are under contract, they kind of give up their efforts on collecting rents and things like that. Then all of a sudden, a month or two goes by, and when you do get the reports, the income has gone down, and now that raises a red flag for from the lender standpoint. So, you're juggling a lot of different things when you're trying to get these loans approved.
Yeah, absolutely. 100%. If you guys like this content, I'm going to ask you to like, subscribe, and share. This is how we grow the channel. And all of our podcasts are sponsored by Future Gen REI. Future Gen REI is a Long Island-based syndication, which is Anthony and myself. And what we do is we purchase multifamily property in Tennessee in secondary and tertiary markets. All right, and let's now transition to something that me and you are over the moon excited about, our Dixon property, which is crazy. This is a property that we went under contract after Troy, but give them the story that how we offered on this in 2024 and how it kind of came back to us. And then let's break down the whole Dixon, because we had our appraisal done already. It's a huge value add. It has so many moving parts. It's got a little hair in the deal, but this is the deal that is going to make our beginning careers as syndicators.
Yeah, no, this is a good one. So this was brought to us, I think it was October or November of last year. And the seller had a buyer lined up, and it was brought to, we were kind of brought in as like a backup offer, right? Because they were still in contract or, so we did our numbers and, we made an offer and we were substantially below what they had, on the table at that point. So it was just kind of put on hold and kind of left out there to dry. And then, a few months go by, and then we get the call from the broker, and, he said that their first buyer had, had backed out of the deal or couldn't get the financing, something. And then, they said, listen, he's really got to move the asset. He needs a reliable buyer. So that's why we came back to you guys. So we ended up, getting in contract on this one. And, it was, like you said, there's a lot of moving parts on it. So, very excited about getting this one. That's for sure.
So Anthony gave you guys a great little snapshot. So what happened with this deal was I was just doing follow-up calls with our broker relationships that Anthony and myself met a year ago. And I reach out to this broker, Kyle, and just checking in, shooting the you-know-what with him. And he said, I actually have this deal in Dixon and it might be going south. And what I found is every good deal has a story. So I said, well, what do you mean it's going south? And he's like, well, we ended up, I know you guys offered on this before, and I know it was awarded to another group. And I think it's important for everyone to know in the game of multifamily, it's not always the highest offer that gets chosen. It's sometimes the most credible sponsor who has the greatest track record that gets chosen. So they went with a different sponsor. And then that sponsor, from what I was told, was a group of 5 individuals that were all lenders. And they were going to buy this asset and they were going to do the value add that Anthony's going to tell you guys about in a few minutes. And then they started having internal dialogue. Who's going to manage this? And this deal has such a huge value add with so many components to it. They were like, well, we all have day jobs. Who's going to manage it? Turns out the owner had a relationship with one of the 5 guys, and they ended up just deciding to back out of the deal. They got their down payment money, and Anthony and myself made an offer slightly less than what their offer was. Seller accepted it immediately. We went under contract, we wired our money, and then we had our 30-day due diligence.
Right.
And talk about what it's 56 units, only 44 are online, but talk about what the value add and what our plan is in the value add.
Yeah, so this is a unique asset where the 12 down units are units that were flooded. They were flooded during a storm and they had to be completely gutted. So those are essentially quote unquote offline units. So the purchase price is for all 56, but it's it's valued at 44 right now. So we're purchasing it as if it's a 44 unit. And even at that number, it's still a really good deal. We're getting it at a good number per door. And that's not counting those 12 quote unquote down units. So the big value add here is we want to come up with a solution to prevent a potential flood in the future. So what happened here was there was a flood 10 years ago, and then there was another flood 5 years ago. So it seems like every 5 years or so, this particular property gets a bad flood because there's a creek behind it, and it ends up impacting those front 12 units, right? So they've been offline now for over 5 years, and the plan here is so what we did during our due diligence period was we said, hey, okay, let's get a civil engineer in here. Let's get a plan put together. Let's kind of price out what it would be in order to put in some sort of flood prevention plan, right? So that we'd be able to get these units back to life. So that was step one. So we met with a civil engineer. We walked the property. We did all that. We put together the numbers, and then we met with our property managers who are going to then go ahead and renovate the units while the flood prevention plan is being installed. So that's the really big value add there. I could kind of dig into the numbers a little bit. It's going to end up being anywhere between $8,000 to $10,000 per door for the flood prevention plan, and then it's going to be $15,000 to $20,000 to renovate it up to being a brand new 1-unit door. So we'll be in each door for around $30,000 a door for a brand new apartment, which is where the big value add is, right? So it's costing anywhere between $65,000 to $75,000 a door minimum in the area, and those are for typically older apartments. So, this will probably be valued around $85,000 a door, and it's going to cost us $30,000. So there's that instant value add of around $50,000 to $60,000 per door over 12 doors. So you're talking $500,000 to $600,000 value add, within the first 6 months.
I think that, I think you could even share, we had it appraised for $3.1 million. As is. That's
before the units.
And then the appraiser said to us after the 12 units were brought back online.
3.8.
Yeah, $3.8 million.
And we're paying 2.75.
And we're paying 2.75. Yeah.
Right. So and then it'll cost around $300 to do it, to get it in. So we'll be underneath 3.1, and it'll be upwards of around 3.8 million conservatively.
And that's not even us renovating
and
or being
units, yeah.
The existing units. right? So I think Anthony did a great job explaining it, but basically we found a civil engineer that works in the Dixon area. And what they said to us was that they solved that flooding issue from the creek for an adjacent strip center, which is right adjacent to our property. And what they're going to do is they're going to build a flood prevention program to protect the property versus a 101-year flood. He said if we wanted to, he could also build a diagram and a plan for a 150-year storm. And depending on price of that, we will bring it to companies that do that work in the area, and they will build this for us. While this is all getting done, we are going to get those 12 units back online. The goal would be to get this done in a year.
Yeah, without a doubt.
Yeah, so we're saying we want to get it done within a year, and the reason why we want to get it done within a year is I failed to mention to you guys, because I want Anthony to explain it to you, this property was not financeable by any of the agency loans. So what we did is we had to go out and get a bridge lender to finance this property, and this is not something that I would say the average person is able to obtain. It's due to our relationships in the real estate world, where we're able to get a bridge lender that's going to finance our equity. Our equity is coming from us, but is going to finance our.
They're going to finance the property.
They're going to finance the property.
They're going to give us an 18-month loan. They're, because of the relationships, we're getting really good rates for bridge funding. So, it gives us more than enough time to implement, get the units up and running, implement the flood program, renovate the units, get it up and running, and then we'll just have 56 operating units. And then at that point, we could go back to Fannie and Freddie, get an agency loan, and kind of refi out of that bridge financing. So,
so that's our game plan for this property. So it's definitely got a little hair on it because of the 12 down units. It definitely has a little hair on it because it's not financeable by traditional Fannie and Freddie agency loans. But we feel that we mitigated as much of the risk as possible by getting a quote for the civil engineer, by getting a quote from our property management team that we already have an incredible relationship with, what it's going to cost to get these 12 units online. And we're telling our property management team, we're telling everyone this has to be done in a year. Well, me and Anthony know we have in our pocket an 18-month bridge loan, which will give us ample time to refinance out of this, hopefully pull out some equity that we could either send back to our LPs, or we can keep and use that money to renovate the other 44, if that's something we decided to do.
Yep. Yeah, we have a lot of options once we get to that point on the refi. So it's an exciting project.
Yeah, it's a very exciting project. A little bit different than our current assets that we've been working, because our current assets that we've been working are much more slow and go, right? I don't want to say slow and go, but they're like
they're stabilized. They're a lot more secure. It's a 18-month to 24-month, process to turn them over and implement the model. This model is a little bit shortened. It's a little bit faster, a little bit quicker. But a lot of upside on this one.
Yeah, a lot of upside though. I want to tell you guys a little bit about the Dixon market, because if you look at where our current going to be two assets one that we own, one that we have under contract. Those are in a tertiary market, Western Tennessee. I don't want to say very rural, but rural, and about 2 hours and 20 minutes from Nashville. I'm going to say the entire county of Dyersburg has, on a good day, 20,000 people. Where Dixon is 50 minutes from Nashville. Dixon has 60,000 residents. So 3 times the size of our current assets. We would consider it a secondary market. It's a market that's feeding Nashville, definitely a commuter market. And the other stat that I really love is there is only 13 properties with 50 units and above in all of Dixon.
Yeah, no, it's a great asset, and it's and none of them are trading anywhere near 65,000 a door.
Listen, I wouldn't recommend pricing real estate off of this, but the emails that I get from all of the brokers for Dixon multifamily is 100 to 140 per.
Yeah, it's a great area. And we were there. We loved it. We drove around. We said this, and in the proximity to Nashville, you have a lot of people that commute. It's like here. It's like you're working in New York City and then you commute out to the suburbs, every day. And
Yep.
it's a great area.
Yeah, it's a really cool area. You could just see the growth of that area. You could see the big box stores. You could see the Starbucks, the Jamba Juices, Whole Foods, all of those major chains. They all have an infrastructure there where when you're heading to more tertiary markets, you'll have your McDonald's, your Burger King, your Pizza Huts, but you're not seeing some of your higher end chain restaurants in those markets.
Yeah.
And let's dive in a little bit on the Dixon property. How do you look at it on cap rates? So what cap rate are we buying it on? How do you look at the cap rate when we go to sell it? Like, talk a little bit, because somebody reached out to me, one of our listeners put a comment in that they were trying to understand, first break down what a cap rate is, and then how you know what properties and I guess areas have different cap rates.
So depending on there's a few things that go into the cap rates, but the actual calculation itself is just the net operating income, right? That gets divided into the purchase price, and then that's the essential cap rate. And then the way to value it based on the cap rates is look at the surrounding area, and then see what everything else is trading for and what caps they're in, and then take their NOI and divide it into the cap rate to get what the value should be, of the actual property itself. So
let me pause it, because that's a lot. That's a lot for the average people. So tell me if I'm saying it right, and then you'll pick up. So when you're saying to come up with a cap rate, I do the NOI, which is net operating income.
Right.
So let's say the property is generating $100,000 a year. Then I take away the expenses. Is that correct?
The expenses, not the debt.
Not the debt. All right. So the debt's meaningless. You don't look at the debt, which is good because everyone has different debt situations.
Yeah.
So property is making $100,000 a year, and the expenses would be taxes, insurance, property management, maintenance. So let's say the expenses are $20,000. I take that away, and I'm left with $80,000 in profit. That's my net operating income.
Right.
Okay.
Correct.
Then I take that. What do I do with that?
Well, it depends on where you could divide it by the average cap rate of what it's trading for to get an idea on what the value should be, right? Or you could plug it in. So there's three numbers. There's the net operating income number, there's the cap rate number, and then there's the purchase price number. So you could pull any one of those three and you use the other two to get the other one.
Okay.
Right? That's kind of how it works. So if you have a purchase price and then you have a net operating income, then you have those two. So then you can calculate to get the cap rate on what you're purchasing it at. If you don't know what you're going to purchase it at yet, and you want to do it based off the average cap rates in the area, you have your NOI, you have your cap rate, and then that way, then the formula will plug out what you should be paying for it to stay in that cap rate.
Okay. Very interesting. So just so everyone, all our listeners understand, if you have the net operating income and you have the purchase price, you can get the cap rate. If you have the net operating income and the cap rate, you can get the purchase price.
These are kind of back into the purchase.
Okay. Yeah. What I also think is important for everyone to understand is every sector of commercial real estate trades at different cap rates. So the cap rate that you're using for multifamily would be totally different than the cap rate that you're using for industrial. This amazing content is brought to you by Future Gen REI. Future Gen REI is a local syndication organization with Anthony Loffredo and Bryan Karp as the syndicators, with over 20 years of multifamily experience. We purchase B and C class assets in secondary and tertiary markets in Tennessee. If you're interested in investing, please reach out to us. We're super, super excited to help you build future wealth with Future Gen REI.
Yeah.
And
office and all that. And then the areas matter. But, it goes on the areas. And then it goes by the condition of the property too. So you'll see a higher cap rate if the property needs a lot of work. If the property is in great shape and it's an A class, you're going to see a lower cap rate, right? So there's a lot of factors that have to be put into it when you're going through the numbers. But to your question, I would say we're purchasing at like an 8 or 9 cap, right? And then we're going to be trading out of it at probably, the idea is when you purchase it, you want to sell it. You want to sell it at an average cap rate, but your out cap rate wants to be significantly higher. So that difference between what you purchase it at, that cap rate, and then what you're going to trade it at, that difference is where the value is created, right? So you want to be in a position that you could trade it at you could be at a 14 or a 15 cap rate when you go to sell it, and then you sell it at a 7, and then that delta is where the profit is made.
So if everyone understands that, and if I understand it, the way that you change the cap rate or the way that you make the value is by raising the
NOI.
Yeah. And lowering the expenses.
Yeah.
And if we purchased it at a 8 or 9 cap, then we would love to sell it at a 7 cap.
Right.
But we want to sell it at a 7 cap with much higher NOI.
Yeah.
Now, also, let's put into this, I feel like this is like we're making like a stew. Also put into the stew how interest rates play a piece in what cap rates people are going to purchase.
Yeah. So the thing with interest rates is it has to logically make sense for anybody to purchase a property based on the current rates of the actual market on the debt that they could get, right? So if the debt's at 6 or 7% and you trying to purchase something that's a 3 cap, you're going to be underwater, like your debt is going to be more expensive than what it's costing you to pay for the property. So a lot of times they'll kind of be in line, though the cap rates will raise as the interest rates rise, right? And as the interest rates suppress, so will the cap rates. So, it's really good to purchase in higher interest rates territory, because then if it's a longer play, you're anticipating that the rates are going to go down, and then that automatically, just from a macroeconomic standpoint, will create value in itself.
Okay.
The asset will become more valuable as the interest rates to borrow against it go lower.
So it's
because the purchaser could afford more.
Yeah.
Right. So if they're getting a rate of 3%, they could afford to pay more because their debt is going to be cheaper.
Okay.
Right.
So that's why everyone always says it's a great time to sell multifamily when interest rates are low.
Correct. Right. Because the buyer has more purchasing power, right? Because everything's going to go. This is the fun part about multifamily and these types of assets. It's all logical. There's no emotions, right? You're not dealing with emotions. Mm-hmm. So it's just a numbers game. It's not like single family. So you can't expect to sell something at a certain price if the debt is going to cost you more money than what the cap rate is, right? It's just not going to make sense, and nobody's going to do it.
Is that why you feel like the multifamily space was frozen for a little bit when rates were much higher, or there was uncertainty with the higher interest rates?
When there's uncertainty, everything freezes. So regardless of whatever the state, wherever the rates are at the time, if there's uncertainty and there's unpredictability going forward, and from a macro and a global standpoint, everything freezes, across the board. So the thing is, you'll see a lot of activity as the interest rates go down, because now people get excited because they have more purchasing power, right? So you almost want to try to have a lot of assets ready to go on the exit side once cap rates start coming down and everybody starts to get all excited, right? Because that's when you're going to be able to sell at a higher price.
Yeah, I love
when the rates are going up and everybody's scared and things are starting.
And this is when we're buying.
This is
right.
When you buy.
We've been buying for the last 2 years when rates were 7.
There's not a single person now that is selling an asset, for the most part, that couldn't have sold it for more 3 years ago, right? So that's you're purchasing, and over time, of course, the trend is always going to be upwards. But when the rates are higher and the rates jump, and you give it a little time, let it settle into the brain of the sellers, right? They have to understand that they can't, a lot of times in the beginning it's frustrating. Well, I could have sold it for this much last year. I'm not selling it. Well, all right. Well, then you got to wait.
Yeah.
But if you need to sell and you want to sell to continue building, or whatever your business model is, you're going to have to understand that the prices are going to be adjusted based on what the interest rates are.
All right. So I love watching. I love that our properties are getting more valuable when interest rates are coming down, because I feel like we could just time it right. And like, this is the biggest thing, is like the best time to buy real estate was yesterday. And with our future gen REI syndication, we're just collecting these assets and adding them to our umbrella.
Yeah. Yeah, see, you want to always keep purchasing, but you always want to have stuff ready to be exited on too, so that you keep the ball rolling. And that's the good part. These are not, you don't have to worry if 3 months or 6 months something radical changes. These are longer holds. You got 4, 5, 6 year holds. So that helps mitigate the risk too.
Question that I have that I want you to explain. So you just spoke about NOI, net operating income, and then you spoke about the expenses, and I'm looking at them together, and then I'm marrying them together to look at my I'm marrying the total revenue versus the expenses, and that gets my NOI. Talk to me about expenses. So if I see there's two expense categories, right? There's an expense category for the maintenance, and then there's the capital expense. Tell me how the capital expense plays into that. Are you factoring that in, or you don't care about if someone just spent $100,000 on new parking lots?
So you always want to, you're always going to take the big expenditures, and they're going to be factored into the overall cost and what how much it's going to take to eventually have to put money into that. Or there's two different things. Like you said, there's regular maintenance expense, right? That's always a factor. That just goes by the general condition of the property in every unit.
And like a percentage, right? Do you usually use?
It depends. There's an overall percentage that we use. It's kind of like a benchmark across the board. It's typically around 40% of the NOI is really the sweet spot for where
all expenses.
For all expenses, right? So if they're reporting that there's only 25% of NOI is in expenses, then there's something missing, right?
Mm-hmm.
They're not operating at that efficient, and it's very, very difficult to do that. However, if you see they're reporting 60% expenses to the NOI, then there's some opportunity there in order to kind of cut down. So the goal is always try to get it to 40 or less. And obviously there are factors that are uncontrollable: taxes, insurance, things like that. But that's, again, why we chose the certain areas we did, so that we could mitigate those, and we're not as high at risk for insurance to double because we're not on the coast, and we're not, we're in a good area as far as weather goes. The capital expenditures is essentially doing something like, so the way that we categorize it, right? So let's take St. John's, for instance.
Yep.
Now we're 4 or 5 months into it, and then we have expense reports that come in from the property managers every month, and they have to be chopped up into what is a capital expense and what is a regular maintenance expense. The maintenance expense is if somebody's faucet leaks in an existing unit, we got to go in there, we got to fix it. That's a maintenance expense. That goes on the month. That's the monthly. That's the number that you want to kind of calculate inside of your NOI. The capital expenditure is you choosing to now go and say, hey, we're going to renovate this entire unit. It's going to cost $10,000. That's not an accurate thing to put that right into the NOI. That's a separate line item, right, outside of the NOI.
Okay.
Right? Because it's a one-time expense. So it's not something that you could see recurring next month. You're not going to put $10,000 into that unit next month. Right, it's not going to cost you $10,000.
So if we spend $500,000 in capital expenses on St. John's, when they review our T12s, they're not going to look at those as expenses, because they're going to see that money was spent and everything has been brought up.
Right.
And now they're going to just look at our T12 versus your typical yearly maintenance.
Yes. Yeah. You want the thing that you're looking at most is the recurring expenses, right, on a monthly basis. And when you're reviewing and ordering the T12s, that's what you're looking at. Mm-hmm. So for St. John's, it was, remember they did the roofs, right? They did the windows, they had all those things.
I didn't realize how big it was.
Yeah.
It's only now that we're dealing with Troy where I'm like, holy cow, like this is an animal. It's a lot.
It means a lot. So that it's almost like coming straight off of the purchase price cost, right? For something like Troy, we know we have to do roofs, windows, and parking lot. That's all exterior stuff that has nothing to do with the interior renovations of the properties. So those are big capital expenditures that have to be put into, essentially, you have your purchase price, and then you have your capital expenditures that you're going to have to, so you need to raise for that, right? You need to account for all of that when you're modeling out what you think the numbers are going to end up being on it. So St. John's was nice because we only had to worry about interior renovations that we chose to do.
I didn't realize what a great deal St. John's was until maybe 6 months into it. At first, I was like, wait, maybe we're paying a little bit too much for it. But then the more and more we move the ball forward, I was like, wait, this is a great deal.
Yeah.
Because there's not a ton of capital expenses. A lot of the major stuff has been done already on the property.
Yeah, that's huge. And then what happens is, like, for the St. John's model is there's not a big cash hit that you need to come out of, that the fund needs to come out of.
Because we're doing one unit at a time.
But you're doing a couple units at a time, and you're using the cash flow from all the existing tenants to fund it.
Yeah.
Right. So if you were going to make cash flow in $20,000 that month, but you renovated 2 brand new units, well, now you're break even. But again, you didn't come out of pocket for that, essentially, right? Like from a cap stack standpoint.
That's great.
Right?
It's unbelievable.
So
it's been working out really well because we're able to cash flow.
Your cash flow, you're just reinvesting that cash flow into the units and into the building itself, so that you're pulling less money. You have to pull less money into it, essentially, so that the pool of investors and their capital is smaller, which makes it a bigger piece for each person to split on the exit.
I love it. I love it.
Yeah.
That's all the time we have for you guys today. If you guys like this content, please share it, subscribe, write us a comment. If you're interested in investing in multifamily real estate, if you're interested to see what deals Anthony and myself are currently fundraising for, please reach out to us. We'll set you up with access to the Future Gen REI website, where we have all of our deals that are actively being fundraised for, all of our deals that we've actively closed, and everything you could ever need in the multifamily real estate space. We'll see you next time.